you?
I mentioned Jonathan Krinsky from BTIG, their chief market technician, was here in the house at the New York Stock Exchange. Welcome. Good to see you in person for a rarity.
Yeah.
How vulnerable are stocks, do you think, right here?
Yeah, it's good to see you in person, Scott. Just a quick shout out to BTIG's annual charity day happening today, raising a lot of good money for some good causes. So, yeah, look, I mean, the crux of our note this week was eye of the beholder, and there's really two ways to look at the current market landscape. The bulls will say S&P back to 4,200, NASDAQ new highs. That's good action. The bears will take the other side and say, there's weakness under the surface, there's microcaps breaking down to 52-week lows, regional banks, we know about those problems. And so what we did is we looked at, what do new bull markets typically look like 6 or 7 months after the bottom, which is, according to the bulls, where we are now. And if you go back to the 2003 bottom and the 2009 bottom, 6 or 7 months later, you had a pretty stark contrast in market performance where microcaps performed the best, then small caps, then mid caps, then large caps, then mega caps. Pretty stark ladder. That was the exact same from off the 2003 bottom and off the 2009 bottom, and with the exception of the FANG stocks, it was the same off the 2020 COVID bottom. What does the market landscape look like right now? It's the complete opposite. You have, FANG stocks doing the best, then the mega caps, large, mid, small, micro caps. Micro caps actually hit a new 52-week low today. So from our perspective, that's not the hallmarks of a new bull market, and therefore, we think equities generally continue to work to the downside.
Are we going back to the bottom?
Look, I think 3,600 or so is certainly in play, and it's not a stretch to get there. And you can see what happens today when a couple of the large cap names kind of catch down to what the small and mids are doing.
Jonathan, the duration of this correction is clearly longer than what we've experienced in the last 12 years. Where are we in the cycle when you study duration, thinking about the corrective behavior?
Yeah, I think the closest analogy would be off the tech bubble, right? That was kind of a 2.5-year bear market. So clearly, I think we're getting to the point where you have to start having the major indices head back lower if, in fact, this is just a bear market rally, which we think it is. So I think we've seen it before. It's certainly much different than what we saw in 09, where it was more of a V bottom. But I think we've seen this playbook before.
What do you think?
I think he's exactly right. He's stating the facts, right? Micro caps, small caps, equal weight, everything has stunk relative to the FANG-weighted S&P 500 and NASDAQ. What that's telling me, from a fundamental point of view, you and I know how we run, right, is that this market still believes very strongly there is a recession imminent. And it may well be right, Scott. I am balanced in this. It may well be right. The reason that I place a lower emphasis on it is both because earnings are coming in better than expected. I know this is not your world. And because the labor market, for all of the cracks, is really still hanging in there quite strong. I could be wrong, though, Scott. I could. But this market is screaming, the technicals and the fundamentals are screaming recession is imminent. At this moment, I disagree.
Does technology hang in there?
I don't think you can't go back to the October lows with technology hanging in there, but I think if you look even within technology, it's the same story, right? You've had the biggest cap names doing the best. You've had equal weight semiconductors down significantly over the last few weeks. Software has been kind of a little bit vulnerable. So I don't know what it's going to take to get people to pull the ripcord on those mega cap names, but I do think to get to 3,600, you're clearly going to need to see those names roll over, and I think they will.
Why would they? Well, I mean, especially after they just reported, and all of them gave you every reason to feel confident in why you've been putting your money there.
Yeah, I mean, look, if you look at the other part of this picture is the credit markets, and if you look at credit default swaps on investment grade and high yield spreads, they did not confirm what equity volatility was telling you. You can look at it within the technology space as well, not confirming what technology is doing. So I think ultimately what gets those mega cap names to sell off is that everyone is largely full there. I think to some extent people have been buying those as a way to play the upside in equities, but more liquid, more defensive aspect. And so, it's our view that those are largely full at this point, and sometimes you just get a hangover post those earnings. Yeah.